We need to talk about Wells Fargo. They're the multinational bank who has repeatedly been in hot waters for handing out bad loans and opening fake accounts in order to boost their numbers. But this video is about something slightly different and much more unknown. While Wells Fargo certainly treats its customers like shit, they are also apparently the same way towards their employees. The Department of Employee Benefit Security Administration investigated Wells Fargo and Great Bank Trust Company, which is the trustee of the employees of Wells Fargo's 401ks. They found that the two companies caused the 401k plan to pay too much for Wells Fargo's preferred stock. So what's the difference between common stock and preferred stock? Well, common stock gives the holders voting rights for the board of directors' proposals, along with a claim to the company's assets in the event of a bankruptcy. Preferred stock is kind of like a hybrid between common stock and a bond. They pay dividends at a fixed rate like a corporate bond, and holders of preferred stocks have priority over common stockholders if the company is ever liquidated and the assets need to be divided amongst the shareholders. So an easy way to think about it is that the common stock are the most common types of stock. They're just the normal, everyday, mundane stocks that people will often have in their portfolios. Preferred stocks are always going to be more expensive than common stocks since they get paid an additional dividend along with a priority claim to the company's assets if they ever went under. Preferred stockholders are a little bit like a bank lending money to the company in that sense. This fraud was likely done because they had borrowed money between the years 2013 and 2018 to buy the preferred stock shares for the Wells Fargo's employees' retirement accounts. Not only did the investigations find that Wells Fargo and Great Bank caused the plan to pay more for a stock than it would be worth when they were deposited into the participants' accounts, they also found that Wells Fargo used the dividends paid on the preferred shares to fulfill its obligations of making contributions to the 401k plan. By using the dividends to repay the stock purchase loans, they effectively caused the 401k plans of its employees to pay more for each share of stock than the participants would ever receive. To put it simply, the employees not only paid a premium to hold Wells Fargo stocks in their retirement accounts, but their 401ks also didn't receive the dividend payments that they were owed. Because of this robbing of their employees' future, Wells Fargo was forced to pay $131.8 million to these employees, along with a $13.2 million penalty, for a total fine of $145 million.